Yeah, I've been a huge gold and silver bull here, and I think it's just beginning. So gold, my target on gold has been for quite some time, 3,000, and I think that's a conservative estimate of where it goes pre-bust. So my targets, when I put out a target, I'm saying pre-bust. So, you know, I think gold can go to 20,000 by the end of the decade for reasons we can go into when we talk about the bust. But pre-bust, I think gold can go to 3,000. Silver, I have a target of 60, and I've been saying of late that I think if it gets through 60, you could see 75 very quickly. So 60 to 75 is kind of where I see silver going this year. So those are big moves. And the miners, which have lagged, and they've had to move out of their bottoms of a few months ago, but they've lagged. I think they have huge upside from here.
Why would gold go up in an environment when all other risk assets are going up? I mean, presumably if you have things like the S&P going up 50% or 40%, according to your call, then capital needs to flow into those risk assets. Capital wouldn't be flowing into safe haven assets like gold, right?
Yeah, it's interesting because I think people have a recency bias where they assume that the precious metals have to move opposite of the market, the equity markets, and yet go back to the first decade of this century, 2001 to 2011. You had a bull market in stocks during a good part of that, and you had a very big bull market in precious metals. So there are times when they move together, and I certainly think this is one of those times. Technically, they look very strong. Gold obviously has moved to all-time highs, so there's no resistance above it. Silver's got a lot of resistance to move through, but I think it's a very thin area that once institutions decide that they need some of that because the momentum is there, you will see that the prices can move dramatically in pretty quick fashion.
Okay. Well, Bitcoin is
And
another.
by the way, let me answer with in
Sure.
terms of the metals. I think rates coming down, and probably the biggest part of it that has not manifested yet, but I think will, is the dollar coming down. I have a dollar target of
Right.
80. So
80. Okay.
so if the dollar's at 106 and I have a target of 80, imagine what that does to metals if I'm anywhere near correct.
Well, the dollar has been strong, so that is quite a contrarian call. Can you elaborate on that? Why is the dollar coming down? Are you expecting other central banks to be more hawkish?
No, well, yeah, I think what it's going to be, not so much hawkish, but I think, and again, this is a contrarian call, but I think we're going to find that the Fed's going to have to scramble and reverse themselves here. And I think the others are going to be slower to do it. So ECB and Bank of Japan obviously is going to be going the other way. They've got issues here that I think are going to come to the forefront here very quickly, where their currency is going down. I mean, their currency is going down. Their rates are about to break out, and they've got a very leveraged balance sheet. So I think you're going to see. I think there is a potential. This is not a forecast, but when I look at the currencies and see what's going on, it strikes me there's a potential here for some sort of an accord. Plaza Accord of 1985. I'm not sure it'll be that, but something where they coordinate the valuations of the currencies, particularly the yen versus the dollar, because Japan can't withstand much more pressure.
Okay. What's going to happen to the 10-year yield? Is it going to retrace 5%? Currently at
Yeah, I
4.65.
yeah I there the 10-year gap down last November from 480. So there's a small gap there at 480, and we're not very far from it. So it could, here in the next couple of days, fill that gap. Other than that, I don't think it's going very far to the upside. I am not in the camp that says we're going to go back to 5% or higher. Obviously we could, but I think 480 is kind of possible, and then I think we roll again. And as I said before, I'm looking for sub 3% here in the next 6 months, and and it could be 2.5%. We could go as low as that. So for that to happen, some of my other call has to manifest itself, meaning slowing economy, starting to look troublesome, inflation rolling over. We find out that the first quarter numbers, the first 3 months of inflation were more of a counter trend move, and that we go back to the downtrend. If those things come to the forefront, I think you're going to see bonds do very well.
Before we get the meltdown, then bonds will still perform well.
Yeah, I think bonds go from here to 250, let's say on the 10-year, maybe sub 3 on the 30-year. Obviously shorter rates will come down. And then, it's possible from there we get a counter trend move back up. They're not going to go straight down. So you could see 2.5, let's say back to 3.5.
The trend, the recent trend for the 10-year has been up. Something has to happen for that to reverse course, right? What's that catalyst, do you think?
Well, again, trend is short-term trend. Yes, it has been up, but don't forget we were at 5%, went to 380. So what we're dealing with here, in my opinion, is a counter trend, not the main trend. So if it rolls over, it resumes the main trend, which takes it sub 3, maybe to 2.5. Then we get another counter trend from 2.5, maybe back to 3.5 during a period where, why do we get that? We could get that because the Fed looks at the market at 7,000 or somewhere between 6 and 7,000 and says, my God, animal spirits have broken out. We got commodities running. We got to tighten. So they could, even though they begin easing, and I don't know whether that means rate cuts or, no more QT or what have you, but they could then reverse themselves back right on the eve of a global bust because they're so worried about the market breaking out and tighten at the very wrong time, the exact wrong time. So you could get a counter trend move in rates back up, not all the way back to here, but, back up 100 basis points. But I'm not so worried about that. Let's get to the 2.5 first and see where it goes. And then if we get that counter trend from there, or even if we don't, from there during the global bust, I'm calling for the 10-year down to 0 or below and short rates to negative territory. So I do think there is one lower low in rates coming next year during a global bust.
Bitcoin, then, how do you see Bitcoin fitting into this picture? I'm guessing you think Bitcoin is also going to melt up alongside stocks.
Fortunately, I don't have to make that call because I have begged off of Bitcoin from the very beginning. I've said I just don't follow it. So
all right.
I think it's a tough call. If I were following it today, I think it's a tough call which way Bitcoin goes from here, because it does look. I could make the case either way, but I don't follow it closely enough to be somebody to listen to about that.
Fair enough. Let's talk about this global deflationary bust. What is that? What are we referring to exactly?
Yeah, so there's shorter term policy and longer term policy implications. I think basically my thesis for a global bust is that we have leverage in the system so much higher than it's ever been before, and we're heading for a downturn. So, I think when I say leverage higher than ever before, we've got 320 trillion in global debt, right? Both private and public. We've got quadrillions in notional value of derivatives, which is leverage on the markets. So, even looking in comparison to 2008-9, we are so far beyond anything we've ever seen before. Leverage works well on the way up, right? It helps enhance returns. On the way down, it really exacerbates problems. So first and foremost, the reason for a bust is that leverage can turn a normal downturn into something far worse. We saw that in 2008-9 in spades. The leverage in our banking system was why we had a financial crisis like we've never had. This time, you've got leverage far beyond that. Our banks, particularly our large banks, are in better shape because of 2008-9, but European banks are in trouble. The Canadian banks didn't learn our lesson. They were in good shape back in 2008-9. Their system is very leveraged today. Australia's leveraged. China's got problems, obviously. Japan's very leveraged. So I think the problems could come, the catalyst could come from overseas, but it's going to be global. We'll be a part of it. And the other piece to this, so I go, if I put a formula together, it's leverage plus fragility caused by the pandemic. I think under the surface, we still have a lot of imbalances caused by what happened in the 2020 to 22 area. Yes, we've recovered statistically. Yes, lots of areas have done well, but lots of small businesses failed and lots of others are hanging on by a thread. It created, because of the response, the 5 trillion in QE and all the debt we put out to deal with the pandemic. It's caused a very fragile system. We've got and I'm talking about the US, but it really is around the world. There's more fragility in the system going into what I think will be a recession this time around. And that just will exacerbate it'll be a global recession.